Take this job and shove it. I ain't working here no more.
Hi everyone, and welcome to today's training presentation. I'm Marcus.
I'm Jake.
And I'm Kate.
Alright, in this short presentation, we'll walk you through Fluor Corporation and how they manipulated their financial statements, particularly with two major construction projects.
Got that money on my mind, I'm thinking money.
Most importantly, we'll look at what new auditors can learn from this case and the PCAOB standards that guide auditors to make sure that this doesn't happen.
Quick background on Fluor Company. It is a global engineering and construction firm founded in 1912 by John Simon Fluor. It is a public company traded on the New York Stock Exchange. It has 27,000 employees worldwide.
This project's taking so long and so expensive, I don't know what we're gonna do.
We're cooked. There's no way we're making money on this thing. So the primary fraud occurred with those two construction projects, the Penguins project
And the Radford project. Starting with the Radford project, it started in 2015 when Fluor finalized a $245 million contract to build something for the Radford project. By 2016, employees at Fluor realized that the designs that were given beforehand were flawed and the project would have additional cost and time associated with it. To offset growing costs, Fluor's created fake project change notices, also known as PCNs. By the end of the project, Fluor had $502 million worth of revenue that they said were accepted PCNs, but that were never accepted by the company that they were doing the work for.
In the second of those two projects, the Penguins project, involved Fluor submitting a bid for $491.7 million to build a floating facility. And the main problems that arose with this contract had to do with their subcontractor. They made up 25% of the total project bid, and their job was pure fabrication. And when they finalized this bid, that subcontractor's original bid had expired, so they had to be renegotiated, which took up a lot of time and energy and contributed to rising costs on the contract. The original margin on it was $33.9 million over the life of the contract. By 2018, Fluor employees realized that wasn't going to be a realistic scenario, and the project had reached negative $19.4 million in revenue. Despite that, in quarter two of 2018, Fluor still recorded $23.5 million in total revenues.
Got that money on my mind.
After the restatement of their financial statements after their proceedings with the SEC, there was a total overstatement of $17 million in net earnings, or 22% of total revenue in quarter two.
In both projects, they had journal entries to make it seem like they were doing better off than they were. Starting off the Radford project, they had extra revenue to get them cash or accounts receivable. This is that journal entry that they would use.
And then in the Penguins project, it was the case of hiding costs. So they should have had construction in progress, debit, and then accounts payable or cash credit. Neither one followed the rules. And so both amounted to a loss, which they did not record until that restatement came after the SEC proceedings, with the debit to loss on long-term contract and the credit to construction in progress.
This project's gonna be way more expensive and take way more time than we thought.
You're just a stupid construction worker. You don't know what you're talking about. We gotta make money on this thing, damn it.
Got that money on my mind, I'm thinking money all the time.
So why did this fraud occur? Senior executives, including business line president, CFOs, CAO, and senior vice presidents, were compensated based on achieving profit targets. Reporting losses would reduce bonuses and damage their reputations. In addition, Fluor had repeatedly assured investors that its bidding strategy was disciplined and profitable. Reporting sudden major losses would contradict this message.
When Fluor finally recorded the losses in 2019, the stock dropped more than 30%. By delaying loss recognition, executives preserved short-term stock value, directly benefiting anyone that owned stock. Although investors ultimately sued Fluor Corporation, leading to a $33 million settlement.
Got that money on my mind, I'm thinking money all the time.
Alright, so now we can finally get to why you're all here, the learning part of the lesson. So under the current environment of auditing standards in the PCAOB's framework, there's three really main ones that have to relate to what Fluor did wrong and what they can do better. AS 2110, which is the identification and assessing of risk of material misstatement. So this prescribes that whenever dealing and auditing with revenue, the auditor should always presume a high fraud risk, especially in this case with the construction accounting, which involves long-term and complex accounting methods such as Fluor used. And then AS 2110 again, paragraph 70, it says that when you have special audit considerations, you should assess risk of material misstatement and fraud risk as extremely high. As soon as the auditors recognized that Fluor had been sending out project change orders, that should have set off alarm bells and should have triggered this provision in AS 2110. So under the PCAOB standards, specifically standard 2501, which has to do with auditing estimates and fair value assessments, there's three main methods you must use. The PCAOB compels auditors to use them, either one or a combination of the three of them. First, you need to test management's process for arriving at revenue and gross margin. So ask them about what their processes are, actually examine documentation from the projects and see how they are arriving at their estimates. You can develop your own independent expectation, so you can just look at the contracts at face value and develop your own estimate for what they should be recording each month, look at current product costs and current material costs, that sort of thing. The third one is you can analyze subsequent events. So is the company or is the client, their customer, actually paying them for the work they're doing in the amount that they're reporting on their financial statements? Or you could look at what they've recognized and what the change orders that they've been setting out, what those look like. You could also ask the client themselves, hey, did you guys get this change order? Have you guys approved this? Have you ever seen anything like this before? So another option auditors have at their disposal, according to the PCAOB, is the use of an auditor specialist. Specifically, this also comes from 2501, paragraph 8. And this basically says, if you have knowledge that's lacking in a certain industry, or there's a special case, for example, like a jewelry company, if you're not sure how to appraise a diamond, which I'm sure a lot of us aren't familiar with that, you can go ahead and call in a specialist. And particularly in Fluor's case, the specialist could have given you information about current market conditions as to the plausibility of their revenue projections, whether or not those project change orders were likely to be approved or disapproved, whether the cost forecasts were unrealistically low, whether they were being optimistic in that specialist's historical experience and just their knowledge with the industry. And then with those subcontract pricing, were they necessary or were they realistic, even though they virtually were guaranteeing losses? The last thing is you could also send third-party confirmations. This comes from section 2310, auditor's use of confirmation. These would have been extremely useful in verifying those project change orders. So that's really what this whole fraud revolves around, is were those project change orders real? Did they actually have authorization from the company to account for greater revenues? So they should have sent a positive confirmation, compelling the client to respond with the exact balance that they were actually approving.
Throughout researching Fluor's case, this is where we believe new requirements could be used in the PCAOB standards. We're looking at AS 2501, paragraph 8, which states that you can use a specialist if you want to, but we think a good change would be to develop a self-inventory of industry knowledge on what you're working on. We know that auditors have the accounting knowledge to do stuff, but we don't know if they have the industry knowledge, so we should require them to have an auditor's specialist if their industry knowledge is insufficient.
To wrap up, the Fluor case teaches new auditors three major lessons. Skepticism must increase when accounting relies on management estimates. Revenue from change orders should never be recognized until enforceable. Auditors must challenge, not simply accept, management's forecasts.
My jeans are stained and my boots are worn. Just trying like hell to be a good old boy.